This is how you can make 1 billion in one trade. As disclaimer, none of what we say should be taken as financial advice. This is purely educational.
According to experts, in 2023, there's a 60 to 90% chance of recession, and I'm sure you want to avoid that. Now, over the past 7 months, our FIRL Pro model portfolio has grown by 18%, while the market has fallen by 3%. Now, if you're interested in learning how we did it, we've got a special free training just for you on the 23rd of March. So go ahead and sign up in the comment section or the description.
Okay, MJ, so Stanley Druckenmiller.
Yes.
Right, so he is quite a famous, but then not many people actually know him.
Yep.
And he has actually have been as a fund manager, hedge fund manager for over 30 years, and
Yes.
he made like 1 billion in one trade.
Yes.
So that is that's a very, very powerful track
Well,
record.
he didn't make it for himself, right?
Yeah,
But he did it under the Quantum Fund when he was working with George Soros. So that is an important difference. He didn't actually make it, but using the fund's money, he did it. Yeah.
Right. Okay. So here are the not 15. We actually shrunk it down to 10 because we think that this 10 is more insightful.
Yeah.
And yeah, let's check it out. So the first one is invest in the future. So this is what he commented. It doesn't matter what the company is earning now or in the past. You have to visualize the situation 18 months from now. And whatever that is, that's where the price will be, not where it is today. So basically, he believes that investors are focusing too much in the present.
Yes.
And to always you have to have your own judgment based on the fundamentals in the past and right now, what can you project them to make in the future?
Yes.
Yeah. So yeah, any further comments on this?
So basically, one thing to help with this is the idea of mean reversion. So in the stock market, things are never really as bad as it seems. And things are never really as good as it seems as well. So it is quite helpful to be a little bit contrarian in that if someone is very positive about something, it becomes more attractive to take the opposite view, because if a lot of people are positive about this one company or any asset, chances are the assets have been bidded up quite a bit. And your opportunity of making money is a lot lower. Now, the reverse is also true. If something has been beaten down a lot, it just means that it's worth looking at now because there could be mispricing.
Yes.
So I'm not saying this is what you should do or you should follow these investors, but we just filmed a video about SVB, and there's a lot of fear about SVB right now. But there are a handful of investors coming to actually invest in SVB.
Yeah.
So that is the kind of attitude or at least mindset you need to have where, hey, is it really as bad as people think?
Yeah.
And then is it really as good as people think? So that's where the visualization of 18 months from now is going to be. People like to react to immediate, emotional concerns. But then 18 months, is it going to be an issue? So whatever issue we have now, just think hard about where we'll be in 18 months, as Stanley Druckenmiller says. Now, a case in point would also be Russia and Ukraine. It's still going on, the war.
Yes, exactly.
But you realize how now people are...
Yeah, no, there's no news actually.
And it's not even 18 months.
Yeah.
Right? Whereas 1 year ago, Russia's in war now.
Pull out your money. Crash. World War III.
Yeah. So again, it's never really as bad as people think, and it's never really as good as people think.
Yeah.
That's it.
Yeah. Hey, number 2, money versus knowledge. So this is actually advice for you if you are started your career and you're just going out to the job world. And basically what he says is that if, let's say, you're given 2 choices, right? A great mentor and a higher pay, he advises you to actually take the mentor every time, because I believe you can learn more. The money is worth more if you follow a mentor versus you just get a high paying job. Yeah, so that's actually a very simple analogy right here.
It's simple, but a lot of people won't do this.
Yes, exactly.
Now, this is an entire topic by itself, but if you have the privilege to choose between two, always choose the better mentor. I'm going to be upfront here. The beauty about thinking like that, right, is that it's almost like a no-lose situation. And why I tell you this, if you go for a good mentor, right, either he's bad or he's good. If he's good, there's nothing to talk about. If he is bad, there's also a thing to learn about, right? You just learn what not to do. And to be completely upfront, that has been my case in my past, let's call it 7 or 8 years. I seek mentors and I haven't had the luck to find great mentors. But the mentors that were not so good that I've had did teach me things in reverse, right? Things of what not to do. This is very invaluable because what happens when you focus on money, in my point of view, which is the case for a lot of people who go into the corporate world, they see the pay, right? It's like twice the fresh grad pay or whatever, and they go into it. And it's almost like a gamble because chances are you're not going to get a good mentor because he or she's probably also stressed out with his own job. There's no time to guide you.
Yeah.
And you get a lot of money, but then you're usually siloed into doing one thing. And you don't get really to do various things to see the full picture of, let's say, the company or whatever. And then, of course, someone to guide you along the way. Unfortunately, it is not in a lot of people's interest to see you succeed. Right? I'm just put out there. And sometimes the barriers to that is not just in the workplace, but also at home, where people's parents or siblings or uncles, aunties, whatever, actually say, no, this one cannot, that one cannot. You know, they don't actually guide you and think hard about you and about your life.
Yeah. I mean, most seniors, they would try to relate back then versus now, where the situation is both are different.
Yes.
So for example, like you do doctor, you do engineer, you confirm get a high pay. Now it's not the case.
Yes.
So yeah, always look for a mentor that can guide you in the right direction. Not necessarily pay. I mean, you should be even blessed if you got a mentor, and especially it's a good one. And yeah, you should treasure it when you find one.
Yeah.
So the third one is interest rate. So he talked a lot about this also. So basically, he's trying to say that the earnings actually don't really move the market, but it is the Federal Reserve. I mean, that is pretty true. When there's a low interest rate environment, we can see that in 2020, there's actually a jump in every single tech stocks or even like very risky assets like your crypto, NFT. Basically, dump money lah.
Yeah.
That is similar to the case in the tech bubble.
Yes.
When your company name is called .com, immediately your valuation is like skyrocketed like 2 times or 5 times. So yeah, when
last time just a year ago is Web3 or
Web3.
blockchain.
Yeah, exactly. So if the interest rate is high, so that is where you need to be more careful, and that is actually where value investors start to like strive, because value investors are always hunting for bargains and margin and safety and everything. So
what he's saying here is that ultimately, if no new money comes in, the stock or the asset cannot go up.
Yeah, there's no liquidity.
Yes, there's no liquidity. Now, what's very interesting is that actually, I would say earnings and liquidity are symbiotic. They work together. So, yes, it's true. The Federal Reserve actually turns off or turns on the liquidity, right, into the market as we see. And of course, also the Treasury, right? Like when they give all the stimulus checks and all that, steamy checks, right? Yes, it's true now there's more market and more money in the market, and this money will need to find something. So, but then what assets would most likely be attractive to this sort of money? And that is earnings or the potential earnings a company could get. And when there's a lot of money, a lot of that money will be allocated into potential money rather than actual earnings, which is what we saw, right, in 2020, 2021.
Yes. And
that's how you push the asset prices up, right? These stimulus checks are meant to feed you, but people take it and invest. Because at the end of the day, if you give me $1,000, how much can I do with it? Why not take that money and gamble? maybe that 1,000 becomes 20,000, right? I mean, that's the thinking.
Yeah.
And it's actually quite rational. You think about it. Like if I'm living in the US, what's $1,000?
Yeah. And imagine if you hear your friends are making like 20x or 30x. That's
so
another...
you're like, why not give it a go? If I lose all the $1,000, then so be it, right?
Yeah.
So he's right? Like I think it makes a lot of sense what Druckenmiller is saying, because ultimately, if the reverse, let's say you take the company can have earnings and is growing, right? But if there's no liquidity in the system, as we know, with some of the companies we cover in FIRL Pro as well, their earnings growing, right? They're doing well, but there's no attention.
Yes, exactly.
Right? So they kind of work together, right? The liquidity comes in so that companies with good earnings and whatever will be elevated. But then when the money comes in, it's not just going to go to random companies. It's going to have to choose as well, right? Which company to go to. And that's where the earnings profile is very important when it comes in.
Yes, exactly.
Hey guys, if you're interested in building a 6 to 7 figure portfolio using the power of stock investing, head over to the comment section or the description to sign up for our free masterclass so that we share with you exactly how we do it.
Hey, the fourth one is surprisingly concentration. I believe a lot of people think that diversification means your risk is lower because, you basically hedge against your risk from this diversification. So his style of investing is putting all of his eggs in one basket. And he mentioned this very carefully. Is basically he watches that basket very closely and very carefully. So that is one big differences if let's say in a concentration versus a diversification portfolio. So if you diversify a portfolio, it doesn't mean that you don't care about your portfolio. I mean, you still need to know. Who knows? Maybe the stocks that you invested in are all garbage.
Yes.
So if you diversify everything into garbage, you still get garbage return.
Yes.
So basically concentration is key and invest in the right thing.
Yes. So this is very important if you want to make almost like Hall of Fame returns, they call it.
Yeah.
You cannot invest in like 50 companies. You can't. But I do think that, his £1 billion bet, that comes with an obsession to read up about things 24/7.
Yes.
And that's why it makes sense for him. In fact, they made £1 billion mostly because they put in a big chunk of their fund in it, and also they leverage the fund. So I think there needs to be context around this. You swing, this is if you believe you have to swing big on your best ideas, but you need to find those best ideas. And I think realistically, most people cannot find an idea or don't have the capabilities to find that kind of idea where they can go all in. Yeah. So that's where some diversification comes in, but you don't want to go, 50 companies and things like that.
Exactly. And this also comes with the risk, as Charlie Munger's Alibaba bet.
Yeah, there you go.
He also put a lot of leverage also. So that's one downside that you need to know. Okay, number 5, it is EQ more than IQ. So he says that good investors are successful not because of their IQ, but because they have a very emotional discipline.
Yes.
So they are not really get carried away from the market's movement. And basically they are emotionless investors. If you are emotionless, you can do well in any sort of investing. Yeah.
That, or to recognize when you can allow your emotions to flow a little bit. I think it's very hard to be zero emotions, right? So how do you limit that part? There's a lot of ways, right? So for example, one big advantage is some of these guys, they have a broker. So when they want certain trades, they call them up and say, okay, do these trades or that. And then the broker, because it's not his money or whatever, he just executes it. He has no emotions. But sometimes if you do it yourself, then you're like, making one more zero, one less zero. You know what I mean?
Yeah.
So little things like that. One thing that I like to practice is I only key in trades if I do trade myself at night when markets are not moving.
Right.
So that helps as well. So it's not really, if you have the ability to have zero emotions, that's great. But if you do have emotions, find scenarios where you don't have to where you don't have to actually put yourself in the situation. It's the same thing as, okay, yes, you technically can resist taking drugs when you are among friends who all take drugs.
Yeah.
But why go close to the fire? Why not say, I will not be hanging out with these guys? You know what I mean?
Yeah, exactly. Yeah. It's an interesting point right there. Okay, the sixth one is a very simple one also. It's about money management. So basically the key to money management is that if you're making a lot of money when you're right and you're trying to minimize it when you are wrong. So basically he tells you that if you know that your bet is gonna be is gonna go south, that is where you need to like be ready to just take the loss and just move on. So don't be hesitate about whatever trades or whatever thinking that you have, thinking that maybe this is a wrong bet or something. Just move away.
One of the best things you can ever learn is to cut loss, even a big loss. That is very admirable, because when, let's say you're down 80%, right? Let's say, and what do you imagine? You feel like your ego is hurt, or you think like, oh, my financial future is this, and all these emotions start coming in. But I think very good investors I see is they say, yeah, 80% loss, it's okay. I'll cut and I will come back another day. And building on George Soros's point about the confidence and ability to win on other trades, that's one of the big benefits of the market, right? The opportunities consistently gets pushed. In fact, every day I feel, right, even for our FIRL Pro research group, like, what are we missing out? Like whether the idea flows are coming in, into our plate. Because I'm confident that, there will be these companies that show up. But if you don't have that mindset, what actually ends up happening is that when you're staring at 80% loss, you start to think make or break.
Yeah.
Like, I need to get back there, right? Or I need to
make back my capital.
Yeah, because you're only looking at it from that trade or that investment. But when you realize, no, it's about surviving and recouping whatever, or cutting whatever loss you cut and moving on.
Yeah.
I think that is a massive superpower. And that's something that even very smart analysts that don't learn for a long time, I would say.
Yep. So that's money management for you. And the second one, which is also something that we cover a lot from our FIRL Pro criteria, which is actually catalyst. So when there's if there's zero catalyst, the stock won't go up. Yeah. Even though how cheap the company is.
Yeah.
So the only thing that actually can increase stock prices is actually one is catalyst, when there's good catalyst. Two is when their earnings start to show like visibility, recover, and then that is where you get your stock price to go up. And yeah, basically he says that to focus more on signal more than just fluff on news.
Yeah, so this is exactly what we are trying to solve with our FIRL Pro program. Right? If you look at the typical analyst report out there from banks, they're very well written, they have nice charts, but they are like 30 pages long. And quite frankly, if you have to wait or you have to read 30 pages to make a decision, it means that chances are the report is just there it's just being filled with a lot of facts that are true, within the industry, but at the end of the day, how does it translate, right? I've seen reports of, I remember there was this one report on Dialogue that I saw, the company. And the guy basically did a analysis of each of the tankers or the spaces, right, that Dialogue has, and say, well, what is the return? I was okay, like amazing stuff, right?
Amazing, yeah.
But then the upside is something like 15%. I'm like, what?
Yeah.
You know what I mean?
Yeah.
So that's why our reports we like to differentiate, because we try to keep everything in just, if we can, less than 5 minutes. You're able to figure out, or at least we point you in the right direction.
Yep.
Where else you can research some more. So it's all about really reducing the time required. And that's why, in this case, he gave his research director a paper, okay? So he never says how many pages, but when you say my paper on X industry, it's long, right? And I don't blame a lot of people who are starting out, especially those who are educated to do stuff like that, because that's how they've been trained, right? You have a minimum word count. When you do exams, you need to be comprehensive and cover everything. But not everything counts. So they bring this attitude, and that's why he felt proud. Because guess what? That's if he did that in the university, the professor will well done.
Yeah.
Right? So it's like, wow, that's how I got the good stuff.
Yeah.
And let me do it now in the private sector, or let me do it now in the analyst world.
Yeah.
Then his director is like,
it's not
whatever.
being appreciated lah.
Yeah. And so you cannot take it personally that someone has said, yeah, but it doesn't matter. In fact, I'm not sure if he put it here. He had the same experience with an analyst about Tesla.
Oh, no, I didn't put it.
So this Tesla analyst said, he wrote a long paper and says beautifully why Tesla is a short. So I asked him, okay, but have you driven a Tesla? That's why I know. He fired him straight away.
Nice.
So again, this is really what it's all about. But guys, before we move on, if you're someone looking to level up their stock investing skills and you need a lot more guidance, we do have a one-on-one program called the Mentorship Program. If you're interested, you can apply it in the comment section or the description.
Okay, the 8th one is something that we all love, which is margin of safety. Basically, just to summarize that you need to focus on the risk reward, and based on the risk reward, that's where you can allocate your position size. And you want to minimize your risk as much as possible. That's the key thing that you need to do.
So with their $1 billion trade, don't quote me on the exact figures, but to some extent, this was the situation. They calculated something along the lines of, if they were wrong about the pound, which is that I believe the bank wouldn't devalue, something like that. They will be losing 2% of their money. But if they were right, they will be making 20% of their money. So it's a 1 to 10.
Yep.
That's the risk reward that they calculated.
Yeah.
And then of course they applied leverage on it. I'm not sure what the leverage was, the size, but the 20% obviously became a lot bigger. So did they know in advance that the 20% will happen? They didn't. They didn't know. In fact, it could have been the case that they just lost the 2% and you have never heard of the $1 billion pound.
Yep.
Right? But then if they lose 2%, are they wrong to make the trade? And in their view, and I agree, is that no, they were still right to make the trade.
Yeah.
You're not wrong necessarily because you got the trade wrong or if you lose money. It's what was the risk reward. And this goes back to the earlier point about George Soros saying that as long as you have the confidence to win trades in the future, you don't have to worry about even losing out here, because this risk reward thing, you can go either way. But as long as you survive and you keep increasing the frequency, eventually, even if you did lose a lot, let's say if it's all 1 to 10, 1 to 10, 1 to 10, right? If you lose 5 in a row, but the 6th one makes you money, it doubles all the losses, or rather the gain will be double all the losses that you made in the first 5.
Yeah.
Or more than double actually, sorry.
Right. So there you go. That's a good example from Druckenmiller. All right. So the last two, it is never be attached. Very simple one also. You just, whatever thing that you invest in, it is a business. It's not something that you should love. It's not something that you should carry in your bed and say that, hey, tomorrow please go up, okay? Yeah. So you just need to have some strong opinions backed with facts and loosely held so that you won't be emotionally attached to that particular company.
Now, I'll tell you why this is actually quite challenging. And the reason is because when you change your mind, if someone is hearing it especially, they might think you are flip-flopping or you don't quite know what you're talking about.
Right.
That's the difficulty. Because honestly speaking, a lot of people don't know what we're doing. Stan Druckenmiller might be an expert, but you see, even he admitted, right, a lot of times I get it wrong. So even he himself will admit that, actually, I don't quite understand everything that's going on. And he has said before, either him or someone associated with him said before that they start with, actually, I don't understand the world. I don't. But many people go into the market thinking, I do understand the world. So let me go and find the investments. For them, they start with, I don't really understand. But this one kind of makes sense. I think this makes sense for these reasons. But always at the back of my mind, actually, I could be totally wrong.
Yep.
So that's what he means by like strong opinions. Like, I think the reason this is going to go up or down is because of this. But I could be wrong, loosely held. Right? So when the time comes,
You are
it's
not,
done,
yeah.
cut.
Yeah. And it's
That's
not
it.
so painful also that way. Because you
Yes.
know that there is a downside risk already and you are aware about it. And once
Yes.
you're wrong, then yeah,
Yes.
that's what time you cut. Okay, so the last one is what fits you. So this one, it is for investors or newbies who actually just got your feet wet in the investing world and you don't know what is your style. I mean, you can always try different stuff. You can try stocks. If stocks is not something that you like, you can try property. You can try crypto. But stick to, let's say, 2 to 3 asset classes. And then you find which investment style fits you.
Yeah.
Maybe long-term investing also is not for you. Maybe you like more speculative short-term. Then learn more about that.
Yeah.
Yeah.
I think the important thing here, the important additional information here that I'll add is the reason why there's this statement is because naturally we want to find the opportunity or the scenarios where we can make the most money.
Yes.
So a lot of people say, hey, as long as I make the most money, I go there. I don't care about style.
Yeah, especially going to US, right? US investing, US tech.
Yeah, a lot, right? Yeah, because US is higher, so right.
Yeah.
Now, here's the problem with that kind of thinking is that the way I would liken it is, look, if you like cooking and you are a great chef, and maybe you earn 15,000 ringgit because you're a great chef, 20, let's call it. Some middle manager guy at an investment bank can be earning 30,000 or more than you. If you have that mindset of I'm going to go where the money is all the time, then you will quit your chef job and go become a middle manager for investment banking. But you'll be so out of place because your true talent and your calling, let's call it, is in cooking. It would be a total waste, not just to yourself, but to everyone around you that you go into investment banking just because you get more.
Yeah.
So that's how I would think about it. Every strategy, even ours, is not the highest return strategy. We would like to think that we are above average, but we cannot say that we have the best returns.
Exactly.
And that's totally fine.
Yeah.
But it's of course hard for a lot of people to accept that because they want to be the best. Right? I just put out a tweet saying that, like, you know, some people have this mentality of, well, if it's not the best, don't bother doing it. If you don't intend to become the best, don't bother doing it. That's such a ridiculous way of thinking. I'm sure you've heard of that before, right?
Yeah.
You're not going to be the best.
I think I heard that somewhere from some YouTubers. Okay,
yeah, so then imagine if everyone thought like that, right? Then a lot of people will give your favorite nasi lemak stall will have given up already.
Yeah, exactly.
Because I'm not the best, so I give up.
Yeah, it's all about trial and error lah. Yeah, you don't need to be the best on everything. You just try different stuff. Eventually, you'll find something that you didn't know that you are the best at, but I mean, it makes you the most money lah. So just keep trying different stuff. And that's the top 10 lessons that we learned from Stanley Druckenmiller. I hope you guys learned a lot from his takeaways. And before you guys go, this is the FIRL Pro.
This is our style.
Yeah, this is our style of investment. Not one trade and one win. We actually have like 15 trades, actually even more. So far, it has been doing quite well. I believe about 80% of the trades are all in the green. And so this is the FIRL Pro stock portfolio on the top one. And if you look at the bottom one, there's a portfolio called the Telegram stock portfolio. So those are more for short-term arbitrage. If you want some quick catalysts, you can try looking at our Telegram stock performance. And basically we'll tell you when we actually buy or when we actually exit from that position. And if you need more information on FIRL Pro, you can check out the free sample. The link is in the description and comments down below. And not to forget that we have a big masterclass going on, which is on the 23rd of March. Make sure to sign up. It is totally free. The links are in the description and in the comments. MJ, any last words? No,
guys, hope to see you, right, in FIRL Pro or the masterclass, or even if you don't attend either, just thanks for your support, watching all the way. If you want to binge some or other content, just
check it out.
click here, and we'll see you in the next video.